Hey everyone, and welcome back to the Safe Simple Sound Podcast Tax Edition. I'm your host, Alex, and I'm thrilled to have you join us today as we untangle a crucial yet often overlooked aspect of tax planning, claiming a qualifying relative. At Safe Simple Sound, we believe in seizing financial control, and a big part of that is understanding all the tools available to you to legally minimize your tax liability. That's where today's topic comes in. We're basing our discussion on a comprehensive article breaking down Part 1, Chapter 3 of IRS Publication 17, specifically focusing on who qualifies as a qualifying relative for tax purposes and how that can lead to a valuable dependent tax credit. This isn't just about obscure tax code, it's about potentially significant savings. The publication highlights some eye-opening points. For instance, did you know that the person you're supporting doesn't always have to live with you to be claimed? Or that there's a strict gross income test, a limit of $5,150 for 2024, that your potential dependent must meet? And crucially, you must provide more than half of their total support. These are game changers for many families, and it's something we all need to fully understand. To make sure we cover this thoroughly, we've structured today's episode into 4 key sections. First, we'll tackle the introduction to qualifying relatives and dependent tax credits. We'll clearly define what a qualifying relative is, differentiate it from a qualifying child, and explain why this distinction is so important for maximizing your tax benefits. We'll also explore how the credit for other dependents differs from the better-known child tax credit. We will ask, why is it important to understand the difference between a qualifying child and a qualifying relative beyond just the terminology? Next, we'll dive into the relationship and gross income tests. Here, we'll unpack the sometimes confusing rules about who can be considered a relative, and we'll break down that critical $5,050 income limit. Are there any relationships that commonly cause confusion regarding the member of household or relationship test? That is a question we aim to answer. Our third segment will focus on the support test and multiple support agreements. This is where things can get tricky, so we'll spend time clarifying exactly what counts as support, from rent and food to medical expenses. We'll also explore those multiple support agreements using Form 2120, a lifesaver when several people contribute to a relative's care. One guiding question here will be, what are some common mistakes people make when calculating support? Finally, we'll wrap up with claiming your qualifying relative and avoiding common mistakes. We'll walk you through the actual process of claiming the credit on your tax return and discuss the potential pitfalls to avoid. What are the most common reasons why a claim for a qualifying relative might be rejected by the IRS? We'll get to the bottom of this. This episode is all about embracing financial flexibility and understanding financial choices, 2 of our core beliefs here at Safe Simple Sound. By understanding the rules for claiming a qualifying relative, you're empowering yourself to make informed decisions that directly impact your financial well-being and potentially help you develop wealth and a lasting legacy by freeing up resources. So, get ready to take notes because we're about to make the complex world of qualifying relatives safe, simple, and sound. Let's get started. First things first, let's define qualifying relative. We're all pretty familiar with the term qualifying child when it comes to taxes, right? Your kids under a certain age living with you. That's usually straightforward. And we discussed qualifying child in detail in our previous episode number 11. But a qualifying relative opens up a whole new set of possibilities. Think aging parents, adult children who might have hit a rough patch, siblings, or even other relatives who rely on you for financial support. The crucial difference, and this is key, is that a qualifying relative cannot be your qualifying child, or anyone else's qualifying child for that matter. This distinction is vital because it determines which tax benefits you can claim. If someone meets the criteria for a qualifying child, you'd typically claim the child tax credit, which can be quite substantial. But if they don't meet those child requirements, they might still qualify as a relative, opening the door to a different, yet still valuable tax credit, the credit for other dependents. That answers guiding question number 1. It is more than terminology. It determines which tax benefits you may claim. Now, let's talk about that credit for other dependents. This is where things get interesting. Unlike the child tax credit, which is specifically for, well, children, the credit for other dependents is designed for those individuals who rely on you but don't fit the qualifying child mold. This credit can be worth up to $500 per qualifying relative. That's real money that can go towards groceries, medical bills, or anything else that helps you support your loved ones. Knowing this, and that is our second guiding question, you can see how this might impact a taxpayer's financial planning. So, how do you know if someone qualifies? The IRS has 4 tests, and all 4 must be met. These are not a qualifying child, member of household or relationship, gross income, and support. We'll delve into each of these in more detail in future segments, but for now, let's just get a basic understanding. The not a qualifying child test, as we discussed, is the first hurdle. Then, the person either has to live with you all year as a member of your household or be related to you in a specific way. We're talking parents, siblings, nieces, nephews, even in-laws. The gross income test means their annual income has to be below a certain limit. It changes yearly, so it's important to check the current amount, which in our reference article was listed at $5,050. And finally, the support test requires you to provide more than half of their total financial support for the year. Think about it like this. Imagine your grandmother lives with you. She receives Social Security, but it's not enough to cover all her expenses. You pay for her groceries, utilities, and medical bills. If her total income is below the limit and you're providing more than half of her support, she could be your qualifying relative, even though she's clearly not a qualifying child. Or let's say you have an adult son who's going through a tough time, lost his job, and is living with you while he gets back on his feet. If he's not a qualifying child for anyone else, his income is low, and you're covering most of his expenses, he might also qualify. Now, I know this can seem like a lot of information, and the rules can get a bit complex. That's why the IRS provides Publication 17. It's your go-to resource for all things tax-related, and it has a whole section dedicated to dependents and qualifying relatives. Seriously, bookmark it, download it, print it out. It's your best friend when it comes to navigating these rules. Our included reference material is based on Part 1 and Chapter 3 of this publication, so we have you covered. The key takeaway here is that the definition of dependent for tax purposes is broader than you might think. It's not just about kids, it's about care and financial support. And understanding this can make a real difference in your tax bill. So here's your call to action. Think about the people in your life. Who are you supporting financially? Could they potentially be a qualifying relative? Start gathering some basic information, their income, their living expenses, and how much you contribute. Just having a general idea will put you ahead of the game. All right, folks, we've just explored the nuances of the not a qualifying child test. Now, let's shift gears and dive into 2 crucial tests that often trip people up when determining if someone qualifies as a dependent: the relationship test and the gross income test. Think of these as 2 separate hurdles your potential dependent needs to clear. One focuses on who they are in relation to you, and the other focuses on how much they earn. We're going to break down these tests step by step with plenty of real-world examples so you can confidently determine if someone in your life might qualify. Remember, claiming a qualifying relative can lead to valuable tax benefits, so this is definitely worth paying attention to. First up, the member of household or relationship test. This one's all about connection. Essentially, the person either needs to live with you all year as a member of your household or be related to you in a specific way. Now, here's where it gets interesting and a little less intuitive. There's a whole list of relatives who don't have to live with you to meet this test, and this list is key. This includes your children, stepchildren, foster children, siblings, half-siblings, step-siblings, parents, grandparents, step-parents, nieces, nephews, aunts, uncles, and even your in-laws. Yes, your mother-in-law could potentially be your qualifying relative even if she lives across the country. Think of it like this. The IRS recognizes these family bonds as strong enough to override the residency requirement. Now, a few important clarifications. First, cousins. This is a common point of confusion. A cousin only qualifies if they live with you all year as a member of your household. They don't get the free pass that the other relatives on that list do. Second, temporary absences don't disqualify someone. So if your elderly aunt is in a nursing home for a few months for rehabilitation, that's considered a temporary absence and she still meets the residency part of the test if needed. Or if your dependent child or parent goes away to school or is on an extended vacation, they will still meet the residency requirements. And finally, any relationship that violates local law, that's a no-go. The IRS isn't going to recognize a relationship that's illegal where you live. Okay, let's move on to the second hurdle, the gross income test. This is where we look at the potential dependent's earnings. For 2024, the person's gross income must be less than $5,150. That's the magic number. Now, gross income means all income before taxes or deductions. This includes wages, salaries, tips, interest, dividends, and even some types of unemployment compensation. It's not what they bring home after taxes, it's the total amount they earned. But, and this is important, certain types of income don't count. For example, some disability benefits, particularly those from a sheltered workshop, might be excluded. So, if you're supporting someone with a disability, don't automatically assume they're disqualified based on income. Check the specifics with the IRS or a tax professional. Let's bring this to life with some examples. Imagine you're supporting your retired mother who lives in her own apartment. She receives $8,000 a year in Social Security and $4,000 in interest income. She meets the relationship test. She's your mother, but her gross income is $12,000, which is above the $5,050 limit. She wouldn't qualify. Now, consider another scenario. You're supporting your 25-year-old niece who lives with you while she's looking for a job. She earned $4,500 from a part-time gig during the year. She meets the relationship test. She is your niece, and the gross income test, it's under $5,050. As long as she meets the other two tests, not a qualifying child and support, she could be your qualifying relative. A couple of quick notes before we wrap up. Adopted children are always treated as your own children for these tests, so they follow the same rules. Also, if you're supporting a qualifying relative who lives in Canada or Mexico, they can still qualify. There are specific rules, but it's definitely possible. Residents of other countries are generally ineligible, but there are also exceptions. So, to recap, we've tackled the relationship test and the gross income test, two critical pieces of the qualifying relative puzzle. We've learned who qualifies as a relative, the importance of that $5,050 income limit, and the exceptions to the rules. Your mission, should you choose to accept it, is twofold. First, review that IRS list of qualifying relatives. It's in Publication 17, and we'll link to it in the show notes. Determine if the person you're supporting meets the relationship requirement. Second, start gathering information about their gross income for the tax year. This will give you a solid foundation for determining if they might qualify as your dependent. Next up, we'll be diving into the often tricky support test, where we'll explore what it really means to provide more than half of someone's support. It's more than just handing over cash, and we'll break it all down. Support test. To claim someone as a qualifying relative, you generally need to provide more than half of their total support for the year. That's more than 50%, a majority stake in their financial well-being, if you will. It's like owning the controlling interest in a company, but instead of stocks, you're dealing with living expenses. Now, what exactly counts as support? Well, it's pretty comprehensive. We're talking about the essentials: lodging, food, clothing, medical and dental expenses, including health insurance premiums you pay, education costs, and even things like recreation if they're reasonable. Think of it as covering the basic necessities and a bit more. Importantly, let's clarify what's not included in support. Taxes that the dependent pays themselves from their own income don't count towards your support. Also, scholarships received by a student are not considered support provided by you. This is a common misconception, so keep that in mind. Okay, let's talk calculation. The trickiest part for many people is figuring out the value of lodging. If you're letting someone live in your home, you need to calculate the fair rental value of the space they occupy. This isn't necessarily what you pay on your mortgage. It's what you could reasonably rent that room, apartment, or portion of the house for on the open market. Imagine you have a spare bedroom and a finished basement that your mother lives in. You'd need to research comparable rentals in your area, similar sized rooms or small apartments, to get a realistic estimate. Let's say that comes out to $800 per month. That's $9,600 per year just for lodging that counts toward the support you provide. Let's take an example. Say your elderly father lives with you. You pay for his groceries, $4,000 a year, medical bills, $2,000 a year, and the fair rental value of his room is $9,600 a year. That totals $15,600. He receives $8,000 in Social Security benefits, which he uses for some of his own expenses. In this case, you are clearly providing more than half of his support, as your $15,600 is more than his $8,000, and you would pass the support test. The source used to cover the other expenses, such as Social Security in this instance, is not important. It's all about who is ultimately paying for things. Now, what happens if no single person provides more than half the support? This is where multiple support agreements come into play. Imagine a scenario where 3 siblings are jointly caring for their aging mother. None of them individually provides more than half of her support, but together they cover all her expenses. This is a perfect situation for a multiple support agreement, which is formalized using IRS Form 2120. Here's how it works. One person, who contributes more than 10% of the support, can claim the dependent. But, and this is key, all the other siblings who contribute more than 10% must sign Form 2120, agreeing not to claim the mother as a dependent. This prevents double dipping and ensures everyone is on the same page. This way, one of the siblings can claim the credit for other dependents to help offset some of the costs. Multiple support agreements are extremely common in situations with aging parents or relatives with disabilities who require care from multiple family members. Let's briefly touch on a few specific situations. Social Security benefits, as we mentioned, are generally considered to be provided by the recipient, even if they're used for their own support. For state support, like welfare or food stamps, those are typically considered support provided by the state, not by you. TANF payments, under proposed regulations, are considered support you provided if you received them and used them to support another person. Foster care payments from a child placement agency are considered support from the agency. And finally, if you make a lump sum payment to a home for the aged for a relative, the support you provide each year is calculated based on the portion of the cost allocated for that year, considering the person's life expectancy. One common mistake people make is underestimating the fair rental value of lodging. Don't just guess, do some research. Another mistake is assuming that if someone receives government assistance, they can't be claimed as a dependent. That's not always the case, as we've seen. Finally, remember, the key is who ultimately pays the expense. It's important to track every expense. So, to recap, the support test requires you to provide more than half of a person's total support. Support includes a wide range of expenses, but not things like the dependent's own taxes or scholarships. Multiple support agreements allow one person to claim a dependent when multiple people contribute, as long as everyone agrees. These agreements, documented on Form 2120, prevent anyone else from claiming the same person as a dependent on their tax return. Here's your call to action. Grab IRS Publication 17 and find Worksheet 3.1. Or use a similar online calculator. There are plenty of free ones available. Use this worksheet to estimate whether you provide more than half of a person's support. If it's a close call, or if several people are chipping in, seriously consider a multiple support agreement. It could make a real difference in your tax burden. We've just wrapped up a deep dive into the intricacies of multiple support agreements. Now let's shift gears and put it all together. We're going to walk through the actual process of claiming that qualifying relative on your tax return and, crucially, how to avoid some common and potentially costly mistakes. This is where the rubber meets the road, so to speak, and where all that knowledge about those four tests comes into play. Think of it like this. You've done your homework. You've determined that your Aunt Millie, who lives with you and relies on your financial support, does indeed meet all the criteria to be your qualifying relative. Great. But if you don't claim her correctly on your tax return, you won't get the benefit, and you might even face penalties. It's like knowing the ingredients for a cake but messing up the baking process. You won't get the delicious result you were hoping for. So let's get practical. First, the mechanics. Claiming a qualifying relative is actually pretty straightforward on your Form 1040. You'll need their full name, their taxpayer identification number TIN, which is usually their social security number, and you'll check the box that says credit for other dependents. That's it. Sounds simple, right? But as with many things tax related, the devil is in the details, and making a mistake here can have consequences. Let's talk about those potential pitfalls. What happens if you incorrectly claim someone as a dependent? Well, the IRS doesn't take kindly to errors, especially when they result in you paying less tax than you should. You could face penalties, interest charges on the underpaid tax, and potentially even an audit. Nobody wants that. It's like accidentally speeding. You might get away with it, but if you're caught, there's a price to pay. To avoid that, meticulous record keeping is your best friend. Keep accurate records of all income and expenses related to your dependent. This isn't just about proving you provided more than half their support. It's about demonstrating that you met all the requirements. Think of it as building a solid case. The more evidence you have, the stronger your position if the IRS ever has questions. Keep receipts for medical expenses, rent or mortgage payments if you're providing housing, food costs, and anything else that contributes to their support. Organize it, label it, and keep it safe. Now let's address a sensitive but important situation. What if your qualifying relative passed away during the year? The IRS thankfully acknowledges this reality. If your relative met all the qualifying relative tests before they passed away, you can still claim them as a dependent for that tax year. It's a small bit of financial relief during a difficult time. But again, documentation is key. You'll need to note the date of death on your return. And to bring it all home, let's circle back to those four critical tests we discussed in the earlier segments. Not a qualifying child, member of household or relationship, gross income, and support. Remember, you must meet all four. Not just one, not just two or three, all of them. It's like a four-legged stool. If one leg is missing, the whole thing collapses. If you're claiming your elderly parent, for instance, they can't be someone else's qualifying child. They must either live with you or be on that specific list of relatives who don't have to. Their gross income must be below the threshold, currently $5,050, and you must provide more than half of their support. Triple check, quadruple check those requirements. So, what are the most common reasons a claim gets rejected? Often, it's a failure to meet one of those four tests. Maybe the relative's income was slightly too high, or perhaps you didn't quite provide enough support. Another common mistake is providing an incorrect TIN, or forgetting to check that credit for other dependents box. And finally, sometimes people simply don't understand the rules, especially the distinction between a qualifying child and a qualifying relative. If you're feeling overwhelmed or unsure about any of this, don't hesitate to seek help. The IRS website, irs.gov, is a treasure trove of information, and Publication 17 specifically is your go-to guide for dependents. But the best advice I can give you is to consult with a tax professional. A qualified CPA or enrolled agent can provide personalized guidance, answer your specific questions, and ensure you're claiming everything you're entitled to correctly and legally. So, here's your call to action. Before you file your tax return, gather all the necessary documentation for your potential qualifying relative. This includes their TIN, proof of their income, and records of the support you provided. If you're using a multiple support agreement, make sure everyone involved has signed Form 2120 and download that form now if it pertains to your situation. And most importantly, if you have any doubts, reach out to a tax professional. It's an investment that can save you time, money, and a whole lot of stress in the long run. And that's a wrap on our deep dive into the world of claiming a qualifying relative. I hope you found this episode as enlightening as I did. We really unpacked a lot today, starting with that crucial distinction between a qualifying child and a qualifying relative, and why understanding that difference is key to maximizing your dependent tax credit, specifically the credit for other dependents. Remember, it all boils down to those 4 critical tests from IRS Publication 17. Not a qualifying child, member of household or relationship, gross income, that $5,050 limit for 2024, and the support test. We spent a good chunk of time on that support test, and for good reason. It's often where people trip up. Calculating total support, understanding what's included and what's not, and navigating those multiple support agreements with Form 2120. It's complex, but so important. I think the discussion around multiple support agreements was particularly impactful, highlighting how families can work together to provide care and share the tax benefits. The other big takeaway for me was the detailed explanation of the relationship test. It's not as straightforward as you might think. Knowing which relatives don't have to live with you to qualify, that's a potential game changer for many listeners, especially those in the sandwich generation or multi-generational households. Thank you so much for tuning in to the Safe, Simple, Sound podcast Tax Edition. I truly appreciate you spending your time with us. If you found this episode helpful, please consider sharing it with someone who might benefit, a friend, family member, or colleague. And if you haven't already, please subscribe to the podcast and leave us a review. It helps others discover the show, and it helps us continue to bring you valuable financial content. Be sure to check out the show notes for links to IRS Publication 17, Form 2120, and other helpful resources we mentioned today. Remember, understanding these tax rules is all about embracing financial flexibility and making sound financial choices. By knowing who you can claim as a qualifying relative, you're taking control of your finances and potentially building a more secure future. Until next time, stay safe, keep it simple, and keep your finances sound. This is Alex signing off.